All right, thank you. So I'm of course at Carnegie Mellon. I'm currently visiting MIT. Let me begin by thanking the organizers for asking me to discuss this paper. It's really quite a fascinating paper. We've certainly paid a lot more attention to the notion of safe assets since the financial crisis, where in some ways we learned that some things that we thought were safe, and some things that we thought were safe weren't so safe. Much of the earlier literature focused upon the demand for safe assets, and I think this is part of an emerging agenda that's also really trying to address in a serious way the supply. And indeed, it builds on a nice short paper in the AA proceedings that I had an opportunity by the authors themselves that I had an opportunity to read as I was preparing for this. But I think this is a very nice research agenda. And what I see as maybe the most important idea that's really highlighted in the paper is the issue of what are the characteristics of safe assets, and in particular, are there characteristics besides strong fundamentals? And what the paper highlights is it's not just about strong fundamentals, but it's about having potentially deep enough potential markets that these assets can be rolled over, because to some extent, ultimately, at least with respect to short-term, and I'll come back to the short-term point later, but at least with respect to short-term assets, it's really crucial that that there's going to be somebody else who's going to deal with the next round. I think the intuition in this paper is very nice. I think Arvin did an amazing job of both describing the intuition and actually also presenting the formal model. I'm going to focus on I'll highlight a little bit of the intuition and then talk about a range of applications and sort of broader sorts of issues. What the paper highlights is sort of these alternative types of equilibria that if the global demand for safe assets is high, then you need to have, such as U.S. debt, a large debt issue to enhance safety, because that's going to ensure that there's going to be demand on the other side, that it can be rolled over. If the demand is low, then if you have a large asset supply, it might not attract enough demand to roll it over. So basically, this is pointing to links between liquidity and rollover risk, and it's also highlighting that coordination is really key, that ultimately safety is endogenous, and it's really emphasizing this role of size, and it's emphasizing the role of size in a couple of ways. On the one hand, the importance of size, that in order for something to kind of perform this role, it has to be really big, or in some cases it should be really big, but that's not a universal result. You can also have equilibria where it's just the opposite, and I think that's in some ways maybe the most surprising themes. The framework, I've characterized it here as dynamic. You can think of it either as dynamic or static. In any case, the assets, they have one period maturity, and the safety of the asset is linked to the rollover risk, which is tied both to the fundamentals and whether there's sufficient ability of supply to attract investors interested in the safe assets. And I think this link to scale, as I've emphasized, is a surprising and very nice feature, and the ambiguity about whether you want big scale or not is also a very important feature. So first I want to just comment briefly about the savings glut, this idea that there's high global demand for assets. There's been a lot of attention paid to this over the last 15 years, and I think the paper highlights that there's perhaps more scope to think about this seriously and deeply, and what the ramifications of this are. I think the paper is really highlighting that the notion of savings glut has helped sustain the U.S. Treasury's role as being this safe asset, and that indeed this could change if there were enough deterioration in U.S. fundamentals or move to low demand for safe assets, which could lead to substitution, whether the German Bund, although obviously that's very small in size, as Arvin highlighted, or perhaps something like the Eurobond proposal. So sort of turning to that a little bit, can Europe offer a safe asset? So here, and sort of reflecting on this. So first, clearly, Europe is obviously collectively, Europe is a very important economy. The euro, of course, is an incredibly important currency, and currency unification obviously tremendously increased the scale. You can think of currency now. Currency is sort of different than bonds, but you can think of the currency unification event that happened 2 decades ago as sort of changing the scale of Europe. And this was kind of obviously one of the central decisions in the European economy 2 decades ago. But at the same time, of course, as I think events over the last decade or so have also highlighted, the European structure in some ways is a little bit awkward. Why? Well, because basically European debt remains, and this kind of emerges indirectly with the nature of the proposal here, European debt remains country specific. Why? Well, because basically fiscal authority is country specific. So the individual countries in the current political economy of things, the individual countries are issuing their debt, own debt, and they have the taxing authority, but yet the central banking is essentially done at the level of the European Central Bank in terms of the euro. Indeed, some of the tensions between these two different models of, on the one hand, having the central bank that operates basically across much of Europe, but on the other hand, having the fiscal authority in the individual countries, this is really at the core of some of the challenges that Europe has faced with the issues about the viability of the debt in some of individual countries, particularly in the countries in Southern Europe. And indeed, I think in some of the discussion in recent years, it really kind of highlighted the theme that was also out there in the beginning of the euro, which is whether this type of model would be sustainable. So I think the proposal for the Eurobond is sort of an interesting one. It kind of gets at these issues in an interesting way. It sort of tries to finesse to some degree the moral hazard, and it highlights a different kind of sense in which coordination is key to the potential success. I think in my own thinking, I think also thinking about the role and connection to the moral hazard and the potential issues of fiscal coordination, and how the fiscal coordination issues might be dual to the coordination issues focused here, might be worth further thought. So just to kind of follow up a little bit on the point about relative fundamentals. So relative fundamentals, in some ways the paper is highlighting, is perhaps much more important even than absolute fundamentals due to the coordination aspects of valuation. And it's highlighting that in the case of the U.S., for example, there's room for the U.S. to deteriorate in its fundamentals. And, and you can see, you see the potential for the U.S. to deteriorate, certainly. You hear about in recent days dramatic increases in government spending. You heard in the fall about dramatic decreases in tax revenues. When you think about the nature, therefore, of what this sort of means fiscally, and you wonder, well, does this endanger the U.S.'s status in some ways? And the paper sort of, I think, casts interesting potential light on that issue. And indeed, so maybe there's a little less discipline from the markets on this issue because of this role of scale and size. And I think these are potentially very important insights to emerge from this agenda, both sort of directly and indirectly. The way this is sort of summarized in the vernacular is, sometimes you want to have the best place in a bad neighborhood, and this is sort of often, even when people are kind of critical of the U.S. fiscal management, that's good. That's often how investing in treasuries is viewed, and this is basically the point that Arvin emphasized about the negative beta of the safe asset. And I like the example associated with what happened to the valuation of treasuries at the during the core of the financial crisis. But I want to suggest an alternative example, which in some ways, I think the example of what happened in the financial crisis is perfectly fine. Clearly, there was a rally in the treasuries then, and the like. But I think in some ways, maybe even a cleaner example, or at least a companion and kind of a very interesting example, is what happened at another event, and that was S&P's downgrading of the U.S. in August of 2011. S&P, just to recall for those of you who don't remember, S&P downgraded the U.S. from AAA to AA. And as this was happening, and as there was even some expectation that this might happen, people wondered what would happen with respect to all kinds of aspects of our regulatory structure associated with this downgrading, and what would be the import of this for our capital markets. Well, it turned out the import for our capital market, and in fact, people at the time I'm former SEC chief economist. At that time, only a few years removed from being in Washington. So I even had people calling me to ask me, well, what would happen if the U.S. bonds went from AAA to AA? And well, it turned out that first of all, the SEC, they figured out some workaround so that the Treasury AA could be treated like it was AAA. And sometimes at the SEC, they're sort of good at figuring out some of those kind of workarounds. But separate from that, I think what was fascinating is that everybody kind of anticipated that what was going to happen with the downgrade is that the Treasuries were going to go down. And what happened was, well, maybe initially they went down, but then, kind of like occasionally other events, instead of the Treasuries going down, the Treasuries started rallying, and the Treasuries rallied pretty strongly. By the way, most of the other assets, they went down. So here you had this weird situation. The other assets went down, the Treasuries went up, and basically the major shock was this downgrade. And I think that's a very interesting event that really fits this scenario in a really interesting kind of way. And the reason I like this example, even relative to the crisis example is a good one. I mean, and you have nice magnitudes and the like on that. But what I like about this example, in the crisis example, basically everything was going down. And in this one, the Treasuries were being downgraded, but they rallied, and everything else went down. And the point basically is that it really illustrating the flight to quality in just such a dramatic, and what it means in such a dramatic way, in a way I think that was kind of, I thought at the time, completely unexpected. And so I think that's an example really worth thinking more about. And I think in some ways, for the reasons I've described, it's maybe a cleaner example than the crisis. So let me turn to a different aspect of safe asset. So here the framework is all about rollover risk. And so I thought about this from the point of view of the financial crisis itself, and something that clearly wasn't a safe asset, but where rollover risk was big, and that was the case of Bear Stearns. In Bear Stearns, rollover risk was a huge first-order issue, and it partially was a first-order issue endogenously, because Bear Stearns' situation wasn't so good, and therefore they basically had to fund short-term. So Bear funded short-term, and the problem was so they needed to be short-term, but they were too reliant on it, and then they couldn't roll it over. But it's all kind of so the rollover couldn't happen. Now, the firms that were further out in the term structure in their funding, those Wall Street firms, for the most part, survived. The ones that were in a worse situation with respect to financial structure. So this points to, in my mind, kind of a potential issue with respect to safe assets, that the role of maturity, it's kind of ignored in the framework. And it seems to me it's maybe worth thinking deeply about that. And to the extent that we also have data on the term structure, on both quantities and pricing, that could be a really interesting issue. But obviously that goes beyond, in a way, the issues of safety are mitigated if you take the rollover risk either, well, you don't take it fully off the table because even a 5-year bond gets rolled over. But I think there's some interesting issues there. And finally, and so I know I'm kind of out out of time. So one final issue. As I thought of the issue of safe assets, so it seemed to me there's kind of another issue people sort of talk about that's kind of related, but it's kind of different, and that's the issue of reserve currency. So here, basically, financing in the safe assets provides a special privilege. It leads to low funding costs, and it's kind of related to the safe assets being a store of value, and arguably, this is an economic advantage to the U.S. Interesting question, how valuable? And maybe this framework can be used to kind of tease numbers out with respect to that. I mean, I think it has the potential to do that. This is a little bit related to a complaint, focusing on reserve currency as opposed to safe asset. It's related to a complaint of China. China has been complaining in recent years that the US dollar is the reserve currency. Now, I think this is sort of different. It's different. It seems like that's more about medium of exchange and unit of account. But I think it's worth understanding the connections more deeply. I do think in both contexts, the issue of coordination is important, I bet in different ways. And so, I think this is a really terrific paper, and I think it kind of potentially opens up our ability to get at a lot of central issues in international monetary, international macro and monetary economics.